I'm Marilla Fernandez. Thanks for joining us today on Market Call. Tony Ciero is our guest today, Vice President and Senior Portfolio Manager, Caldwell Securities. He'll take your questions on North American large caps. Here's how to reach us. 1-855-326-6266. And if you want to email your questions, marketcall@bnnbloomberg.ca. Good to see you. Thanks for coming in.
Thank you, Marilla. Pleasure seeing you as well.
It's a snowy day again, so we appreciate people making the trek. Canada lost 84,000 jobs last month, and the majority of them were full-time positions. What do you think economists may have been missing in that piece of the puzzle when they were predicting that we would gain?
Well, we had a strong 2025, and hence the markets did quite well because of it. So we pulled back. I think they missed the youth unemployment, and that was one of the leading reasons why it went up that high this time around. And even though youth unemployment reached about 12.5%, I personally believe it's a lot higher than that. It's not counting the people that have yet to participate into the markets. We need to look at ways to improve on that. And one thing I always say is cut taxes, especially on small businesses. They're the backbone to our economy. If they start having a gain, fantastic. Then you get the youth unemployment numbers down and potentially the overall unemployment back down again.
Okay, we've seen some of the American tech companies lay off thousands of people because they're getting that AI benefit already. I'm wondering whether you think that's a factor yet on this side of the border.
I think AI is the easy narrative to blame here. I don't think it's just that. Sure, it has its place, but it can't be attributed 100% to the increase in unemployment in Canada or the U.S. The U.S. has the model somewhat correct. They have been cutting taxes. There's pressure on reducing interest rates, and that's spurring the economy. That's spurring growth. Carney, great. He's doing some deals, at least on paper, to expand the defense up north, some deals overseas. But how about here? How about we start cutting some taxes here, reduce the interest rates here, and that will, on its own, start promoting growth in Canada.
Okay. Do you think we might see more of a movement towards that with the new employment number out?
I hope so, but on the flip side, you're going to see inflation as well with the price of oil over $100. That's going to be inflationary. So Tiff Macklin has a tough job.
Fine line, right?
Fine line, absolutely. So I hope it leads to lower interest rates.
Okay. Let's leave it there. We will get to some phone calls and some emails for Tony when we come back. Once again, here is the phone number to reach us as well as the email address. Tony will take your question today on North American large caps. Back in a moment. Welcome back. We're going to start with an email right now from Griff. He says, do you think Netflix is a good buy? We'll turn this question over to Tony Ciero, who joins us now in studio. Of course, Netflix bowed out of the bid for Warner Brothers and seems to have bounced back as a result. Would you put money into Netflix at this point?
I'd be a little patient. It's good. I think Netflix did a very good job backing out of the deal. They offered something like $82 billion, but Time Warner came in at 100
Paramount, yes.
Paramount, sorry, came in at $100 billion. So Netflix would have increased their lending on their balance sheets, which would have sort of derailed a little bit of the balance sheet. So I'm glad they backed out. But when you look at Netflix, the management is very strong. They know how to make revenues. And about 10 years ago, all we cared about was subscription rates. And if it went higher, the stock went higher. Now they have to sort of shift and see what other areas they can produce revenues. So right now, I'd be a little bit cautious. It's a mature industry in terms of subscriptions to online viewership. So I would be a little bit cautious putting money into Netflix just now.
Would you wait just to see what it does, sort of post bowing out of that bid a little bit longer?
Yeah, let's see the next growth trajectory that they have and if it's worthwhile investing in.
Got it. Okay. Let's get to the phone lines then. Scott's on the line. He is in Mitchell, Ontario. Hi, Scott.
Oh, hello. My question to you today is on Suncor. I'm just wondering the reason why maybe CNQ is trading a lot less than Suncor, and I'm just wondering if you think there's a catch-up play here during this volatile time. Your opinion only, and thanks so much. Bye-bye.
Okay, thank you for the question. We'll take a look here at Suncor over the last 3 years, and a lot of the companies, energy companies, getting a bounce. Of course, what's going on with Iran. But what is your take on Suncor?
Well, I'll go 3 years ago with Suncor. They did some management changes because they had a spat of fatalities that caused some havoc on the stock. And since then, the company has been run quite efficiently. There was a recent death, I believe, that occurred late last year. But overall, and that's, of course, very unfortunate, but overall, the company management is on the right trajectory. And that's why Suncor has outperformed. So if I'm looking at investing some funds now, should I consider CNQ and a little bit in Suncor, because both provide a stable dividend, both are backed by the price of oil. CNQ, though, does have the natural gas component, and that's lagged a little bit. And if we see a price appreciation there in natural gas, then maybe you see that little bit of bump in CNQ to catch up to Suncor. Because
of the conflict and the bounce they've had only in the last 2 weeks, would you put money in at this point, or would you wait perhaps for the conflict to die down or be over and perhaps see if things come back down?
Well, even before the conflict, these companies were doing quite well. So this is just added to the overall performance. You're still getting a healthy dividend. And if you're looking at money, and the way we look at things, it has to be diversified. So don't put 100% of your assets into one basket, but consider diversification with a couple of energy names. So you can't go wrong with CNQ and Suncor, but also look at other industries in there too.
Got it. Okay, let's get to our next caller. Daniel's on the line. He's in Sarnia, Ontario. Hi, Daniel.
Yes, good afternoon. I would, Chemical has been relatively volatile in the last while. I wonder if the guest could suggest some entry points for this particular stock. Thank you very much.
Okay, thank you. Cameco, sort of a uranium play here. It's at 151, but down on the day. What are your thoughts?
Well, Cameco and uranium and alternative energy to power up these AI data centers built up, I think it's a good buying opportunity. We haven't seen anything towards the end of AI investing. And you're hearing companies like Microsoft and Amazon, Alphabet spending hundreds of billions of dollars to continue building out these data structures or data infrastructures. You're going to need energy and alternative fuel sources as well. So I think Cameco over the last year obviously has participated in that, and going forward, it'll participate again. There's volatility in the markets generally now, and some people are taking off profits on Cameco if you've been there over a year, but I still think it's a good long-term hold from this point.
Okay, I was going to ask you long-term hold because some of the plays for nuclear, of course, aren't going to happen for some time. Mm-hmm. So is this sort of a 10-year hold for you?
Oh, yes, this will be a core hold, at least 5 years, yes.
Okay. All right, let's get to Chetan. Chetan's on the line in Toronto. What's your question today?
Good afternoon, both of you. My question regarding Morgan Stanley. What is the Tony's long-term outlook? It came back significantly from 195, 192 to all the way 150. Should we hold it or take the profit off the table and get out of it?
Okay.
Thank you very much.
Thanks for the question. What is happening with Morgan Stanley?
Well, U.S. banks in general, I'll lump it all together with J.P. Morgan as well. A lot of profit taking. They did exceptionally well last year. And with the turmoil that we're seeing in Iran, yes, it's causing some nervousness in the market. So the winners are generally being sold now. Long term, I continue to hold Morgan Stanley. That's a core holding as well. If you want to take some profits, consider diversifying in J.P. Morgan too. And the reason why J.P. Morgan is the largest bank, capitalized bank in the world, Morgan Stanley is not too far behind. But once you see a rebound there, you'll see both banks do quite well.
Okay, with the unwinding of regulations that is expected to happen this year, and you said profit taking perhaps leading them to drop a little bit, do we expect that bounce back later in the year for some of these financials?
I would go longer than that. Eventually, there'll be a buying opportunity. And the market is experiencing a little bit of this fear of missing out, FOMO experience. And eventually, yes, you'll see people plowing back into it. But right now, with all the geopolitical concerns, what's happening, yes, we see investors take money off the table. I still think, I can't predict by the end of the year, but I still think J.P. Morgan, Morgan Stanley, very well good banks in the U.S. U.S. economy is heading in the right direction. So I still think they're very good holds.
Okay, let's take a quick break then. We'll line up more phone calls and emails for Tony Ciero, Caldwell Securities. He's taking your questions today on North American large caps. Back in a moment. Welcome back. Let's go to an email from Charles. He says, I'm thinking about selling my shares of AEM. What do you think about that? This is Agnico Eagle. Obviously done well with the push up in gold over the last while. Would you profit take right now on some of these stocks?
Depending on your price point, it's gone up over 100% over the last 12 months. So you've doubled your investment. So consider taking some of that off. And Agnico Eagle, very good company, very well run. It's got mines in Canada, Finland, and Australia. Very good jurisdictions to be doing businesses in. So not too much geopolitical concerns. So consider taking some profits and even consider going into the bullion itself vis-a-vis an exchange-traded fund. The iShares gold bullion ETF, I think, is CGL. It's hedged the Canadian dollar, so you don't have to worry about the US dollar movements. So consider taking some profits, especially if you double your return over the last 12 months, and look to invest in gold. We're big fans of gold still at our firm.
Despite the run-up?
Despite the run-up, we still think there's quite a bit more to go, just because of what we're seeing with the U.S. dollar. There's this purpose of trying to weaken the U.S. dollar, and when that's said, the precious metal will continue to rise. Turmoil in Iran is causing the prices to fluctuate here. Obviously, the investors have shifted over to oil now, but gold will come back to life once things settle down.
Got it. Okay, let's go to the phone lines then. Debbie is on the line. She's in Burnaby, BC. Hi, Debbie.
Hi, good morning. Thank you for taking my call. We're a little bit overweight in our telecoms, and we're thinking because Verizon is heading upward, we're thinking about selling. If you could let me know your opinion, I would be grateful. Thank you so much. I'll listen.
Thank you for the question, Debbie. What's been going well for Verizon?
Revenues last quarter, when they reported their earnings last month, were spectacular. Okay. Same with Apple. Highest iPhone sales or revenues for the quarter ever. So same thing with Verizon. But both companies have cautioned. There is this memory crunch all over the world, memory shortage, as all these chips are now being plowed towards the design of GPUs, graphic processing units, to power up AI, that going forward, yes, the returns might not be there. So the answer to your question, yes, consider taking some profits, but I wouldn't sell the entire position. It still pays a healthy dividend, so you get paid while you wait there.
Okay, take some profits, leave some on the table.
Yes.
Got it. Okay. Let's go to Bob. Bob's in Bowmanville, Ontario, with a question. Hi, Bob.
Hi, good afternoon. Just like to ask you about Visa. Maybe a little surprising here. It's been shorter term and longer term, being the 1 year number, are all in the red underwater, and just kind of, it's been a steady Eddie fund for quite some time. Just your thoughts there, if there's anything to look out for? Is it just maybe some market conditions, or kind of what's been going on there?
Okay, we've had a few questions like Bob's where people have looked at Visa and MasterCard, which they put money into, and it's always been very steady, as he said, for many, many years. And then it started going sideways, and now it's starting to dip. What do you think is weighing, first of all, on these stocks?
I think volatility in the markets, profit-taking is there as well.
Okay.
I know in the last 1 year, but it's also with I'm going to say somewhat tied with the U.S. dollar. Now, why we like the stock at our firm is because there talks about, or Visa is already incorporated a stablecoin, accepting stablecoin U.S. dollar as a payment as well. And I think that will propel it going forward. So it has potential, that boost coming from the stablecoin, and also in Canada here, vis-a-vis other companies. So I know it's been bouncing around, but continue to hold it. I think this company will do quite well. And when you're looking at the credit card provider, Visa is the largest one, followed by MasterCard and then Amex. So continue to hold the largest company here, especially when you start seeing more transactions vis-a-vis stablecoin. Visa should reap some rewards there.
Would you continue to hold MasterCard, for example, if you bought into MasterCard?
I prefer Visa.
Okay.
I would prefer Visa at this point.
Got it.
Yes.
Okay. Let's get to an email from Brian. He wants to know if Nutrien's a buy at current prices, and Nutrien benefiting over the last little while from the Strait of Hormuz being shut down and fertilizer shipments getting stalled, which has given a boost to this company. It is up today, well, down today, but up to 113.07 more recently. So what would you do here? Would you buy in where it is?
I wish this question was asked a couple of days ago, and I said yes.
Of course.
Yeah, but obviously the price of fertilizer has been affected with what's happening there in Iran. It's tough to say. Let's give it some time. It's jumped up 7-8% yesterday. Let's give it some time and see how things filter out. Right now, the Strait of Hormuz is shut down, but if it does open up soon, then you can see the price of fertilizer or the nitrogen that's crossed there come down, and potentially you'll see a better buying opportunity in nutrient.
Yeah, so it depends on what comes out of that conflict and when it's over. Okay, let's get to one more email in the blog from Sunny. What does Tony think about Constellation Software right now? What are his thoughts about the enterprise software stocks in general for the rest of the year? This is something we will talk about a little bit more later. But Constellation Software pretty dragged down, as you can see. Again, one of those investments people thought were very, very safe and wasn't going to go anywhere. And AI concerns now are sort of eating into that business. What would you do if you were holding Constellation Software right now?
If I'm holding, I'd continue to hold it. I would continue to hold it. You suffered quite a bit. Since the management CEO stepped down last year in July, the stock has been rocketed. The growth model was always buy other companies and expand that way. But now with AI and more efficiency, it doesn't seem to be an appropriate way to go forward. So I would continue to hold it and see if new management gives them some time to turn things around.
And when you say give them some time, is that like a year window? Is that 18 months? What would be your usual time frame for something like that?
Yeah, generally speaking, when a new CEO takes over, you do sometimes hit this big bath syndrome where you start over, and you'll just take time to righten the ship. So you have to give it at least 12 to 18 months, in my opinion.
Got it. Okay. Let's take a quick break then. We will go through Tony's past picks when we come back. Time now to have a look at past picks from Tony Ciero from August 1st of last year. At the time, he chose Berkshire Hathaway, BRKB, on the New York Stock Exchange, $472.84 US at the time to $493.35 today, 4% upside, 4% total return. Berkshire Hathaway has I know it's a 4% benefit here, but it has stalled in many ways. And again, it's because, or perhaps because of the retirement of the man who leads it. So have you held on to it? What are you doing with Berkshire Hathaway?
We definitely have held on to it. And my choice of making that a top pick when I was here back in August was it was down about 15% at the time since the announcement when Warren Buffett stepped down back in May. And it looked like a buying opportunity because Greg Abel, who's now succeeded.
Leading it, yes.
Yeah, he was under tutelage for Buffett for 15 years or so. So it'd be a smooth handoff in our opinion. The stock did rebound, and I think it was a little bit higher, but earnings came out a couple weeks ago, and a little bit disappointing. Revenues were down across the board, in particular their insurance division, their private insurance divisions, and that used to be a cash cow for them. So management came out and said, Greg Gabriel came out and said, we're still sticking to our ideals. We're not changing fundamentally. So over time, we should see a rise in Berkshire Hathaway.
Okay, so you've decided to hold on to it. And did you pick it up for the first time last August, or did you already hold it?
We held it already.
Got it.
Yes.
Okay. Let's get to your next past pick then. Royal Bank, RY on the TSX at 177.48 at the time, August of last year, to 222.11, 25% upside, 27% total return. With the banks, and I know Royal tends to lead in both price and as a recommendation, do you worry about valuations at all? Is that a concern for financials like Royal Bank?
Yeah, you do take a look at valuation, but when you're looking at earnings, you're looking at other things first. Net interest margins are very important, and their potential for growth. They're all mature. They've been around for a while, straight good dividends. None of our Canadian banks have had any history of dividend cuts, so they continue to grow them. But the reason why I picked Royal Bank and we continue to hold for our clients is that acquisition of HSBC Canada it had done a year earlier. There were other intangibles not necessarily priced into the stock. And we're starting to see that now, even though it's HSBC Bank in Canada, it's still on its parent has that global capabilities. So that intellectual property was passed on to Royal Bank. And they announced back, I think in January, that they're looking to expand their operations in the Middle East and in China. Now the banks in Canada are already saturated there too, but they're looking at the wealth management side. I think that's what will give them a little bit more positioning going forward.
Okay, so the benefits of that you think will continue to pay out for Royal Bank?
Yes.
All right. Let's get to our next pick then. Amazon.com in August of last year was $214.75 US, down to $209.10, 3% downside for both return and total return. I'm sure there was a time when investors thought the Mag 7 were going up and nowhere else. And clearly the shine is off a lot of the big tech at this point. Have you held on to Amazon?
Yes.
Okay.
And this is a long-term hold for us. When it comes to the AI infrastructure, NVIDIA builds or they do the chips to create AI, the GPUs, graphic processing units, to build the AI or train what's known as the large language models. So that's AI. Those large language models need to be stored in this cloud platform. Amazon, Microsoft, they offer the capabilities to companies to participate in the cloud platform. They need to build a lot of data centers to provide the energy needed to have this cloud and this large language model feed into it. This is a long-term story. By no means have we seen anything. And yes, it was maybe a lot of profit taking, a lot of, okay, it's had its course, let's look at something else. I think the war in Iran has taken some of the pressure off the Magnificent Seven.
Okay.
And I think going forward here, Amazon continues to be a good buy. If we did the show before earnings were announced last month, then Amazon would have been in the positive. But when they said in their outlook that they're spending over $100 billion 2026, investors want to see a return on invested capital.
So there's still that overarching concern about how much they're spending and where that return's coming or when that return's coming.
Bingo, yes.
Okay, let's take a quick break then. Tony Ciero, Caldwell Securities, taking your questions today on North American large caps. Back in a moment. Welcome back. We have John on the line. He's in Milford, Ontario. He has a question today for Tony. Hi, John.
Hello. Tony, I'd like your thoughts on Bank of Montreal. I've owned it for a long time. I've owned all the banks for a long time. And with this volatility going on with Trump, I added a fair bit yesterday, and I'd like to start adding some more. What's your thoughts going forward? Thank you very much. Bye.
Okay, thank you for the question. We talked about Royal Bank. How do you feel about Bank of Montreal?
We like it as well. Again, stable dividend. Never had a history of cutting that. If you look at the banks in general, last year they did quite well in their portfolio management, wealth management divisions. Assets grew because the markets lift, and they're continuing to receive the same percentage fees on top of a higher asset base. So we're going to see a little bit of lift in the wealth management division in terms of revenues. You've been a long-time holder, great, John, so you reap the rewards, but I would say also caution, diversify your portfolio. The banks could be under pressure here. If inflation starts to rise, then interest rates will rise and mortgages will start to default. Some of the banks are already seeing that going forward, and they have put more money aside to loan loss provisions. I pick on Bank of Montreal just because back in 2022, when interest rates rose, they were hit the hardest in terms of loan losses, in particular their U.S. loans. So a little caution in the wind here. If you already hold it, don't look to buy more. Consider other places to diversify.
You mentioned how much some of these financial institutions are benefiting from the fact that the volatility and much more trading during that volatility of last year with Donald Trump's first year in office and tariffs and everything else rolling out. Do you feel like this year they're going to have that same benefit? The volatility is different. It's coming from Middle East conflict, and that's just the start of the year. Yeah. But do you think that'll be a tailwind for some of the banks as well? Yeah,
the capital markets, they're trading. We can see revenues increase there. So there's potential there. But on the wealth management, that's their assets under administration that they're managed. If they're earning 1% across the board, if that asset base increases, still 1%, you're going to be getting more revenues. But on the capital side, the trading side, the volatility occurs because people are trading a lot more. They're selling a lot more. So that should help out the banks in general as well.
Okay. Let's go back to the phone lines. Perry is on the line in Curtis, Ontario. Hi, Perry.
Good afternoon. I'd like to ask Tony, get his comments on Thomson Reuters. Prior to the last 7 days, it bounced off the bottom and had about a 30% upside return. Over the past week, it's pulled back by about 7%. But I'd also like to find out how Thomson Reuters is going to be affected by the introduction of AI.
Okay, thank you for the question. So, this is a topic that you know a lot about, where the whole software business got hit. Thomson Reuters, in particular, got very hard hit. And they've come out and said, look, our database of information is ours. AI is not going to access it. And we're using AI internally to benefit our clients, which other software companies are saying the same. Where do you stand on this outlook for software?
I think it's overdone. It's oversold. And AI is not going to be that quick to replace a company like Thomson Reuters and so many more companies in the U.S. that have been hit hard because they're considered the software as a service. Yes, it makes things more efficient, but Thomson Reuters does incorporate artificial intelligence in their program, and their data is their data. So I think it's oversold. And we as a firm are looking to get into it as well. So if you got into it a couple weeks ago, unfortunately, you've seen a little bit of a dip, hold on to it. Eventually, things will change around for these software as a service companies.
Do you think investors are underestimating how much these companies are going to benefit from their own AI internal applications? Because I think people are looking at the broader AI applications and thinking it'll take their business, as opposed to looking at each company and how they're using AI?
It's exactly that, yeah. So there's a lot of underestimating what's happening within these companies, and it's more of a general sentiment that AI is going to take over this. We don't need it anymore. And then there's a selling pressure because of that, in our opinion.
All right. Let's go back to the phone lines. Bill on the line in Bowmanville, Ontario. Hi, Bill.
Hi. Thank you for taking my call. I'd like your guest thoughts on comfort systems. I've held it for some time and done very well. Does he think there's more upside? Thank you.
Okay. Thank you for the question. They do sort of heating and cooling, and I guess they're part of the data center build-out projects?
Exactly why they've seen the lift over the last several years here. I would say yes to the caller's questions. Yes, continue to hold it because a lot more money is being plowed into building out the data centers. And you need it just to house the energy needed to have the cloud and put the large language models.
Is it a competitive space, though? Are there others who can take on that work?
Yes, absolutely. And I'm sure, like in any industry, if there's money to be made, you'll see others come into it as well. But overall, Comfort System is a leading in that, HVAC. They have a lot of contracts with the data center builders, so I would say continue to hold it and reap further rewards.
Okay, that was for Bill. Let's go to an email from Lori. Looking for thoughts on CGI. Is there trouble or is this a good opportunity? I'm going to throw them back in sort of the consulting tech world where they've been sort of beaten down by those theories that AI is going to eat people's lunch. What do you think?
Yeah, again, oversold in our opinion, so perhaps a good buying opportunity. If you look at these companies that do help corporations become more efficient, and I'll just draw a parallel. In the past, before Google came out with Gemini, if you Googled something, you had a list of options and you did a little bit of research to get your answer. So these consulting companies go into a firm and they're given all the information, and they'll take time to seep through all the information. And here's what you need to do to be more efficient. Now, enter Gemini AI, Google Gemini, and you query something, and Gemini answers it for you in a couple of bullet points. So it's a lot faster. You don't have to do the work. So the fear is AI will deplete, like something like a CGI.
A consultant, yes.
Yeah, a consulting firm. So again, we think it's overdone. It's not going to happen overnight, and there will be reasons for these consultants, and a lot of them are incorporating AI themselves, and the market seems to be missing that.
Got it. Okay, let's take another email from Fred, who says thoughts on Dollarama at this point. Dollarama, I know, has been expanding quite a bit. And they're the ones who bought in Australia the reject shop, something like that.
Yeah.
So how are they doing overall?
Quite well, and they're looking to build another 70, 80 stores this year alone, so they continue to expand. I would just throw a little bit of caution here. If you look at the price-earnings ratio, it is quite high, double what the Toronto Stock Exchange. Generally speaking, defensive stocks do trade a little bit higher, but at 40 versus 20, I'd be a little bit cautious here. But they are in growth mode, which is fantastic. If we do see recessionary pressures in Canada, staples like Dollarama will do quite well. Exactly. And that's why we see a little bit of a premium nowadays, these companies. So a little cautious buying it now.
All right, we're going to take a quick break. We'll be back with Tony Ciero taking your questions on North American large caps in just a moment. Welcome back. We have an email from Max. He says, please, is it a good time to buy CN Rail for long-term growth? I know some of our guests have picked the rails as a pickup place because they've been depressed for a while. Yes. What do you think about first rails, and would you go to CN over CP?
Overall, rails, yes. A good long-term buying opportunity right now. Last year, they were hit with the tariff concerns as they shipped quite a bit to the U.S. And now we're seeing a little bit of relaxation on the tariffs once the Supreme Court came in and said, halt it here. I know Donald Trump will look at other ways in imposing tariffs, but the rails should be a good buying opportunity going forward. I would recommend both, like maybe diversify between the two of them. You can't go wrong.
The CUSMA renegotiation period or review period, at least, that is happening over the summer, does that concern you? Would you wait until that's done before you dip into rails? What do you think?
Well, my personal opinion, I don't think there's going to be this three-way agreement. I think there's going to be unilateral agreements between Canada and Mexico, and then Canada and the U.S.
And how do you think that could play out for the rail lines?
I still think it'll be positive because it will be an agreement. And there's a lot of fear of the unknown, and that's what creates a lot of the tension and volatility. The agreement unilateral, if it's CUSMA, there'll be an agreement in place, and at least then the investors can work around that, right? So once you have a known agreement, I think that'll benefit everybody. So yes, I would buy the rails today.
Okay. Let's move on to another email from Ian. Meta, would you still be adding at these levels? Meta's business model, of course, benefiting from AI to target their ads on social media sites. How do you see this company moving forward with the use of AI? I know they cut back on the metaverse funding, but what's your forecast for Meta?
I'll lump it in there with the Amazons and the Microsofts. Meta doesn't offer to the public their cloud computing platform. They all keep it for themselves, for their Facebook, Instagram, and another provider. But the way they're funding these data warehouse build out is, yes, advertising. And the market seemed to like that when earnings were announced last month. It did quite well. It's pulled back since, so I think it's a buying opportunity. But Meta, when it comes to AI, absolutely. I still think we're in its infancy here, and there's still a lot more to come.
And essentially, there's a lot more to come. They're going to benefit more for advertising. They're going to benefit from cloud. How do they compare to some of the others when we talk about cloud? Because they're all trying to do the same thing.
Well, Meta, again, is not making cloud available to the public like Amazon's AWS service, Microsoft's Azure, and Google's cloud platform. Meta's keeping it themselves. So that could potentially be another revenue source if they
decide to open it up.
Exactly that,
okay.
yeah.
Interesting.
And similar with Google or Alphabet on the other side, they're not monetizing their Gemini services. They're not advertising on it yet. And we're waiting for that day to happen. CEOs come out and said, well, not yet.
Is that inevitable?
I think so. Yeah. If you've got a lot of eyes on something, you want to make money off it.
All right, good to know. Let's get to another email from Millie. Is it a good time to buy Palantir? What are you thinking about Palantir?
Let's look at earnings a couple of months ago, and I'll lump this with that software as a service, and they've all been hit hard. What are they calling it? SaaS-copalypse or SaaS-apocalypse?
They're always coming up with some name for it. Okay.
But Palantir came out and fabulous earnings back in February and tremendous outlook, plus government contracts with the U.S. Army. And
that's right.
Yeah, they did quite well in Iran. I'll just leave it at that. So I think right now it's a buying opportunity. Some of the sales have been overdone, a lot of pressure on AI companies because they were the darlings over the last several years. But I think Palantir is a good buying opportunity now and a long-term hold.
Something like the conflict that's happening now, are you surprised you haven't seen more of a boost for Palantir in the circumstance?
Technology stocks would generally sort of get hit first because they're considered the highest risk. So it doesn't surprise me that it hasn't had a boost.
Despite the contracts with the government?
Correct.
Okay. Let's take a quick break then. We have new picks coming from Tony Ciero when we come back. Join us for Market Call on Monday. Teal Lind will be the guest on the show, founder and chief investment officer at Lind Equity Fund. He'll take your questions on North American stocks. That's Monday. And if you miss Market Call, you can check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Let's get to new top picks from Tony Ciero. We're going to start with Microsoft, MSFT on the NASDAQ. When you are looking at the tech companies, particularly the Mag 7, which are down, what are you assessing to determine growth moving forward? Is it just on their latest earnings, or are you taking a bigger picture with something else in mind?
Yeah, I think a bigger picture with something else in mind and making your own inference on what you think will happen. So Microsoft in particular, great earnings. Revenues did quite well, but the stock was depressed. And again, capital spend towards these data centers, over $100 billion. And furthermore, the Azure brand, their cloud computing platform, which they sell to the public, did not do as well as they did quite well, but not as well as the market anticipated. Maybe too much of a premium placed by the market. But Microsoft did something. There's only so many GPU chips to go around. And what they did with theirs, put most of it towards the cloud computing platform to run the models there. But they also shifted some over to their Microsoft 360 Copilot. And that's offering AI to their Excel platform, Word, and PowerPoint. So AI assistants there. They started monetizing that. And I think they have about 10% of their total inventory monetized there.
Was that a smart move, you think, on their part?
Yes, because it's another source of revenues going forward that it wasn't attributed or accounted for yet. So if they're able to saturate more of that market or that part of their business, we can see potential more.
So essentially, they've tucked in Copilot to their Office platform, and so many people use their Office platform. It's embedded there, and they want people to go there instead of going outside to use a different AI source.
We use the Excel, and it's Excel on steroids, in lack of better words. And of course, it's a fee, an additional fee. You first have to pay to get Excel, then you pay an additional fee for this 365 Copilot. So it's a way of another revenue source for them.
Now, because Microsoft runs on software, right? Everybody installs it onto their computers for work, or their business owner does that. Do you worry about a different AI agent reducing our usage of Excel or Microsoft Word or any of the other programs associated with Microsoft?
Oh boy, it'll be hard. It's such a hard barrier to enter. I would say that's akin to creating a seventh Canadian bank. I don't think it's that easy, and you'll need so much more capital. Not too many companies have that capital. We look at Microsoft's about $2 trillion. And there's a handful of companies in the U.S. $1 trillion or more, none in Canada. it's going to be hard. But there are sort of variations of the Excel and PowerPoint and things out there that you can get, but they're nothing to the extent of what Microsoft can offer.
And not as incorporated together so that you can use all of them simultaneously and they work well together.
Exactly.
Okay.
Exactly.
Let's get to your next pick then. ServiceNow on the New York Stock Exchange as Now. This was one of the companies, like many, to get hit and pushed back because of the concerns. Where do you see the value moving forward with ServiceNow?
Again, cloud computing platform they offer and making business more efficient using AI. They've been lumped in with that SaaS and unfortunately been hit. When we looked at earnings last month, tremendous earnings, and going forward, strong guidance, but it didn't stop the market for taking the stock down. I think it's down about 20% this year. So in our opinion, a buying opportunity. It's unimaginable, in our opinion, that a stock could be depressed this much because of the fears of AI taking over certain sectors of this company. But the company uses the AI itself to be more efficient and help other companies perform better. So that's why we like it. A great buying opportunity. We think it's mispriced because it got lumped in with these software as a service companies.
Do you think that there are some software companies that are more vulnerable to an AI play? We saw Adobe, which reported last night, and investors have been dragging that stock down for some time, even though they have a subscription service and a good base of people who use their products. Definitely, it's been pushed down. So is Adobe or something like that more susceptible to an AI play?
Well, you have to look at company management. And ServiceNow, compared to Adobe, the company managed with ServiceNow is far superior. Adobe, we can trace their concerns going back a couple of years ago. They tried to take over Figma and underbid. And Figma went public, and the stock's depressed now. But that would have been going in the right direction, and they did not push. Well, we talked a little bit about Netflix earlier, not going after Warner Brothers would be too expensive, ruin their balance sheet. Adobe should have pushed harder for Figma because then you get all that intellectual property that Figma had created with AI. So Adobe seems to be, unfortunately, more of that dinosaur state and not particularly like a ServiceNow. Hopefully with the CEO change that's going to be happening, they can shift that company around.
Okay, let's get to your third pick, Tourmaline Oil, which is a very well-known Canadian company, gas producer. And I'm wondering, would you pick it up where we are today with everything getting the push from the Middle East conflict? It's at 66.98. Tell me why you like Tourmaline.
Well, first, it hasn't benefit because it's more of a natural gas play and no oil reserves whatsoever. Very good run company. And if natural gas ever sees its price appreciate, then we would see Tourmaline Oil do quite well. So it's the largest natural gas producer in Canada, and people are unaware of that. So they automatically think CNQ, Canadian Natural Resources, or other companies that kind of escapes my mind now. But they are the largest. But CNQ does have the oiled part of it, and that's given the bounce or the nice return. So we like it at this level because we think the price of natural gas will increase. Also, I mentioned a lot about the AI built out, the infrastructure. It needs a lot of electricity to get that going, but also you need generators to back it up. And generally speaking, generators are natural gas powered, something different. So we think potentially there's a boost to the price there too.
A lot of people are hoping that the price of natural gas would rise on the fact that we're getting more out to other markets in Canada. We're building out that infrastructure. And for a long time, that really hasn't happened. Yeah. Do you expect a bump from that build out in infrastructure as well, getting it to other markets? And if so, how far along the line is that?
So the answer is yes, we do expect it. And we're hoping it's sooner rather than later. There's a lot of intentions. Prime Minister Carney has intended to build the pipelines and expand to Europe. So a lot of things have been signed, but not put into motion yet. And once we see things start being put into motion, then we'll start seeing the price of natural gas appreciate and the price of the stock here to appreciate as well.
So could still be sort of a year or two down the line.
Hopefully sooner.
Got it.
Hopefully sooner.
All right. Tony Ciero, thanks for joining us. We're out of time, but appreciate your time today.
Appreciate it. Thank you.
And thank you for joining us today on Market Call. We'll see you back here on Monday.